Hello everyone. Thank you for joining today's session. So let's begin. So when talking something which everyone fear right now is, am I investing at the wrong time? It's such a common concern, especially today when we look at the Nifty, it's corrected from its peak. So just like around September 2024, when we see that Nifty has touched around 26,000, but now it's trading at around 24,000. Whenever market corrects, fear and doubt naturally rise. Some investors panic and think that the market will fall further, and some stop their investments, and some just sit on cash paralyzed, like waiting for the perfect time. But here's the truth you should know: market corrections are normal, they are healthy for long term growth. They create the best opportunity for the disciplined investors. So, understanding the current scenario, today's market is adjusting to global uncertainties like interest rates, oil prices, Indian as well as US.
ஒரு எப்படி இப்படி போயிட்டு பேசிட்டு இருக்காதே பரவாயில்ல அதெல்லாம் ஜாலியா இருக்கும் சரி ஏதோ கேள்வி
Yeah. So when we look today, there are some global uncertainties and election-related kind of news, and of course, the profit bookings are done in this strong rally by the FIS and so. But fundamentally, India's economy remains strong. Corporate earnings are robust, demographics favor like long-term growth, infrastructure spending is picking up, and new sectors like green energy, digital India, and manufacturing are booming. The long-term story of India is still intact. So now, why should you do now? It's very tempting that wait for the perfect bottom. But historically, those who waited for absolute certainty ended up missing a biggest gain. Instead, trying to time the bottom, focus on gradual investing. Of course, that's through SIPs. Diversify across both asset classes. And most important thing, that is the most important thing, which is staying invested. The correction from 26,000 to today around 24,000, it's not a signal to run away. It's a window of opportunity for smart investors. Market short-term movement should not indicate your long-term goals. Focus on what you can control, your asset allocation, your discipline, your patience. The question is not, is this like the right time? The better question should be like, am I ready to invest wisely and consistently? Today, we are here to help you to build that confidence and make investment simple and stress free. So now that we talked about fear in general, let's deep dive into why fear is like investing at the wrong time. First, media amplifies fear with panic headlines. Like every day, we are coming up with kind of headlines like biggest fall in 2 years, market crashes at global risk rise, is this end of the bull run? These headlines are designed to grab attention, but unfortunately, they also create a panic and confusion among investors' mind. The truth is, the short-term volatility is normal, but media makes it like sound catastrophic, like if something is going to happen, such kind of hype they used to give. The next is that kind of fear of buying at the peak or losing money leads to inaction. We should understand this, like many investors are paralyzed by the fear. What if I invest now and the market falls tomorrow? Maybe I should wait for the better time. This hesitation leads to missed opportunities. History shows that trying to predict the exact bottom or a perfect time rarely works. Instead, consistent investing through SIP routes help you to navigate through these ups and downs automatically. Then emotional investing. When fears take over, invest. When fears take over, investors feel like making emotional decisions. Like they sell during falls out of panic and buy during this rallies which are driven by this greed. But you need to understand that the data proves that emotional investing underperform like this who are investing to systematic discipline investing. So investing with a clear plan, not emotion, is just a real winning strategy. So friends, it's important to recognize this pattern. Media panic, fear-driven inaction, and emotional reaction, they all hurt your building journey. So I always suggest you to be kind of keeping out of this side. Now, this is really important, kind of a concept everyone need to understand. Market cycles are completely normal. Market moves in cycles, ups, downs, and sideways. So if you look at the history of stock market, they don't move in a straight line. Sometimes they rise sharply, sometimes they fall, and sometimes they move sideways without much action. Also, you can see this cycle is a part of the natural rhythm of the market. It's like we expect summer, we expect monsoon, we expect winter. Similarly, we should expect ups, downs, and sideways movement in investing too. Every crash in the history has been followed by a recovery. Yes, it's really true. Every single major fall, whether it's it was like the 2008 global financial crisis, recent COVID pandemic in 2020, or even the current correction what you are undergoing, have been followed by a recovery. In fact, after every crash, market have not only recovered, but also gone to make new highs. Why? Because fundamentally business grows and innovation happens and economies expand. And the stock market over time reflects that growth. So short-term falls might seem scary, but in long-term recoveries are the rule, not the exception. You should understand this one. So I will say the same thing. Timing the market perfectly, trying to predict exact top or bottom is nearly impossible. Staying invested is the only way to get away from this. Even experts get it wrong. But if you stay invested through the ups and downs, history shows you are far more likely to succeed. Compounding, it needs time. And staying invested gives you compounding the time, the kind of the time what it needs to work to do its magic, right? So missing just a few good recovery days because you're excited in fear can drastically reduce your long-term return. So I want you guys all to remember that ups are normal, downs are normal, and sideways are also normal. But what matters is that not reacting emotionally, but staying the course. If you can stay with patience and discipline, the market cycle will reward you over the time. Okay, now let's talk about one of the biggest myths in investing. I have discussed this earlier also. Trying to time the market perfectly is almost impossible. Yes, of course. Many investors even now think that they can outsmart the market, but they will buy right at the bottom and sell it right at the top. You think it's possible? Of course, no. But the truth is, even professional fund managers with the access to tons of data and resources rarely get this right consistently. Timing involves two decisions. You guys need to know, knowing exactly when to get in and knowing exactly when to get out. And that's incredibly hard. Markets move based on thousands of unpredictable factors, the factors which even we not even read about. So it's kind of more unpredictable factors where this market is rolling on. So if you are worried about whether this is the right time to invest, you are not alone. But it's important to know you don't have to time the market to be successful. Yes, consistent investing beats the perfect timing over time. See, research and real world data show that people who invest regularly, whether markets are up or down, usually do better than those who trying to jump in and jump out at perfect moments. Uh, See, consistency removes emotions like fear, greed from the decision making process. But you have to see something like instead of guessing whether the market is headed tomorrow, you stay focused on the bigger picture, like long term wealth creation. So SIPs. So as you guys, everyone know that systematic investment plan. SIPs make investment automatic. Yes, you invest at fixed amount at regular intervals, say monthly. Sometimes you will buy at higher prices, sometimes you will buy at lower prices, but over time, this averages your cost out. This concept is called rupee costing average. It protects you from the risk of managing one big investment at the wrong time. Plus, SIPs build a disciplined investment habit, which is one of the biggest factor behind the long-term success. So remember, it's not about timing the market perfectly. It's about giving your investment time in the market. Uh, so yeah, to kind of say consistency, patience, discipline, that's what everything what you need in this game, not a perfect prediction. So let's make this even more real with some example. Imagine two investors who approach the market very differently. We can keep it as investor one and investor two. So on the left, he's extremely smart, has all the tools, data, research, and somehow he manages to invest at the lowest point of the market every single year. Yeah, we can keep it as assumption itself. So every year he times it perfectly. Now you might think, wow, he must be making a kind of a big fortune, right? Now we can meet investor two on the right. He doesn't try to predict the market. Yeah, of course he simply invests on the same day of every year. Let's say like January 1st, no matter what's happening in the world. This is a SIP approach, systematic investment plan where systematic, consistent, and stress-free. Now, here's the interesting part. Even though investor one seems to be doing everything perfectly, the difference is their returns is surprisingly small. Kind of the difference is very small. I mean, see, yes, investor one makes slight higher return on paper, but the margin is not that huge. It actually a very small difference compared to the energy, stress, and precision it requires to time the market every single year. Meanwhile, investor two avoids all the stress and making consistent returns. He's not sitting up late night worrying about headlines. He's not even constantly checking the stock prices or second guessing what's going to do, what the decision is going to make. He's letting the power of discipline and consistency to do the heavy lifting for him. But you just think over a long period of time, 10 years, 20 years, 30 years, this approach wins not just financially, but also emotionally. Because remember, wealth building isn't just about number. It's more about peace of mind, discipline, and staying in the game long enough to enjoy the reward. So the key message I want to share through this example is you no need to be perfect. You just need to be consistent. When you give your investment regularly and stay committed, you give yourself the best chance to succeed without the stress of chasing the perfection. So now Arthur will take over the business. Yeah.
Thanks, Ram. So, what do you do instead? Right. So, first thing, right? Starting early. Now, if you have not started early, that's not going to be a problem as well. Any start is a good start. Any point in time during your life cycle, when you choose to start, that is a good time. Why? Because the whole idea is for you to invest regularly, right? Diversifying your portfolio across asset classes. Now, this is a very important point because this does not mean having three, four funds of the same category. Say if you want to invest in a flexi cap fund, you invest in three flexi cap funds, saying that okay, this is a different. I'm diversifying my portfolio. No, that is not how diversification works. Diversification works only if it is across different asset classes, like equity, like debt, like gold or silver. Right. Most important thing is every investment that you make has to be goal based, right? That's why at Milestones 12, every investor that we work with, the first step itself is to understand the risk appetite, and second is to plan for particular goals and milestones, right? Only when we work with a particular goal or a milestone, you get a clear direction of how much you have to invest in, what is the target amount for that particular goal, and for each of those particular goals what should be your level of contribution so that you can meet it, right? rebalancing your portfolio periodically. Now, rebalancing does not mean anything that has done well should be cut off and put to another idea or another asset class. But as Ram was pointing out, that markets work in cycles. There are periods where things are looking extremely good. There's a lot of euphoria in the market, and at that point in time, you have to take that decision to take some money off the table to go towards another area where there is fear or where there is pessimism or where that asset is not being looked at the way the previous asset class is being looked at. Say, for example, today equity has come off of its all-time high, and naturally the fear is starting to seep in into the equity markets. Whereas you have one asset class that which is debt that is not being looked at uh, by investors at all. There is a lull phase happening entirely on the debt market space. Likewise, on the precious metal side, which is gold, gold is continuously hitting all time highs. Right. So gold is entering that phase of excitement. Right. So it's very clearly visible as to what part of the market you need to invest in because you're looking to diversify your asset class, right? Because you're looking to diversify your entire money, right? So this is where rebalancing comes in. It does not come in just because something has done very well, and it is not short term in nature. Again, it takes time, right? Last point is to consult an expert always. Now, why we tell you to consult an expert is that you need somebody who is very well experienced in the market, number one, and second, in how to meet a particular goal. Right? Understanding your requirement is something that an expert can definitely come with because they have done this for multiple people, hence they can do it for you. That's why we always say that you have to work with an advisor or an expert. Now, Milestones to Wealth has multiple teams here that work for one single investor. I'll put that question out to you. How many people do you think work with one person on one particular on their particular goal on their particular portfolio? You can put your comment in the chat box and then we'll move on and get back to it at the end of it. Ram, you can go to the next slide. Right. What is the cost of waiting? Right. This is coming up to the first point to say that any time is a good time for you to start investing. Right. When you wait for the right time, you are always in doubt. You are always worried about what is going to happen to the market. If I invest today and the market goes down, I am making a mistake. But if I don't invest today as fast as possible, then I will miss out because I think that the market is going to go. Right. Market movements should not be a very big factor to consider. What should be the factor to consider is your goal. So when you delay contributing towards a particular goal, right? You look at the math here. So if you delay a sip of 10,000 rupees a month for a year, that's 1.2 lakhs lost in terms of capital that you can grow, that you can save and then grow, right? So the cost of delay has nothing to do with the market movements, but it has everything to do with how fast you can meet a particular goal, right? Always look at it only from a goal angle and not from a market angle. Then you'll have clear clarity on what is the next course of action that you need to take. Ram, you can go on to the next slide. Okay, now what are the myths? Now I'll put out a question. Do you think that today the market is too high, too low? What is the general observation? What is the general view that's there outside? You can put your comments in the chat box. Very good. There's a good comment. Always ups and always downs. All right. There's a comment that says nobody knows. Okay. Yes, you are right. Markets are always going to be volatile. So that does not. So the reality is that, like Ram was talking about, short-term volatility will be there. Long-term volatility will always be there. Right? So the reality is that markets have hit new highs and they will continue to hit new highs. So that is something that you have to accept. That there will be new lows, there will be new highs, there will be all-time lows, new all-time lows, there will be new all-time highs. Right? There's always going to be uncertainty. The best time, nobody knows what is the best time to invest. Right? That's why we always talk about no. The day you start is the best time for you to start because you can course correct any time later. Because that disciplined approach of SIP is going to be there for you. Okay. So any time is the best time to invest for you. And since today the markets don't seem to be extremely exciting. There's a lot of global turmoil. So this is a situation where investors definitely need to take advantage of. Though it is going to be a volatile year going ahead also. Next year also is going to be volatile. Volatility is not something new, but given how things are looking today, yes, it is a very good time to start planning for your goals and start contributing towards meeting your goals. Ram, you can go on to the next slide. All right, the real risk that you're facing right now as an investor is isn't investing at the wrong time. It's not investing at all. So how many of you actually believe that no, today is the wrong time for us to invest in? So there's a good comment that is valuations are too high. There's another comment that though valuations are high, we can still start investing. Yes, of course, you can start investing. Valuations are not so high as what they were back last year when things were looking too optimistic, when things were looking too rosy to be true. Right? Today is not that scenario at all. Right? Geopolitical tensions have made our valuations come to a range where yes, now is a great time for people to start building onto their portfolios and start contributing incrementally to their portfolios. Right. So the real risk that you're facing is sitting on the sidelines at all times, waiting to see that no, I think that things will go very bad from here and have unrealistic expectations of the market to say that I will start investing only from that. You're limiting yourself at that point, saying that I'm going to stay on the sidelines, and then again regret when things don't work in your favor. Right. So the real risk is not investing at all. Right. So there's a comment that says we can start investing in reasonable value assets. Yes, that's why diversifying works very very well because you're never out of ideas. As an advisor, we always choose a more multi-asset approach because there we will never run out of ideas. One theme that is having a very good period, another theme will not have a good period. So does it warrant for us to go and invest? That is the cause of study. That's why you work with an advisor. Right? There's a comment that says start investing in out of favor themes. That is a difficult thing to do when you invest in out of favor themes. Right? Because at that point of time, it takes a lot of conviction to go into a theme that is completely out of favor, where the fundamentals are deteriorating, where everything is against that particular theme. Right. So that is a high risk sort of approach, which I think that you should do only after you understand your risk appetite, not before. Not following anything that comes on YouTube or not anything that comes out on news channels or Twitter or any other media format. Right. But majorly is to understand your risk appetite and only then going forward. Right. But yes, it can work wonders 5 years later when an out of favor theme becomes an in favor theme. But the period of staying invested, that is what Ram was talking about, of staying invested, time in the market matters a lot at that point when you go in with a high level of conviction. Right. So time, discipline, and strategy are the real game changers for you. When you choose an out of favor strategy, at that point you need to know how you have to perform on that particular pitch. Pitch will keep changing. Right. So who is Milestones to Wealth for? No matter where you start or where you want to go, Milestones to Wealth is for everybody. The whole program is designed in such a way where we want to help investors to set a particular milestone and get onto that path on how you can meet that particular milestone. We will handhold you throughout the entire process. And if you see here, we've basketed each and every milestone into a particular category. So the first is 0 to 2, which is a self-starter. Then you have go-getters. Then you have achievers. Then you have warriors. And the last, you have ambassadors, people who have met that target of 1 crore. Now, it is very easy for you to be able to meet that target of 1 crore. My question to you, how long, if a person starts today and follows a disciplined approach of investing, how long would a person take to meet that milestone of 1 crore? Usually, we have seen somewhere between 7 to 10 years is what it takes for an investor to meet that milestone of 1 crore. Right. So when you work with us, we straight away set that target for you for 1 crore. And over a period of time, when you reach a particular milestone, we start you off with the first milestone that you have. It can be 10 lakhs, it can be 5 lakhs, it can be 15 lakhs, and slowly, incrementally, each milestone uh, requires a different set of behavior. Each milestone requires a different set of contribution, right? And hence, we take you on that journey for you to be able to meet that 1 crore, so that all your other goals, your education goals, your purchasing of a home, you're paying off some loans, all that is met, right? Ideally, we have seen somewhere between 7 to 10 years for an investor to be able to meet that 1 crore milestone. Thank you all so much for joining in on a Saturday morning. Have a great weekend ahead. Thank you.
Thank you all for joining.